Hey folks, it's Alex Blancarn. I'm back at the kitchen table. Today I wanted to talk to you guys about interest rates. Now, I'm sure you've seen all the doom and gloom in the media talking about how interest rates are on the rise. In fact, there was a recent rate hike in October 26, 2022. The Bank of Canada just increased their interest rates by 0.5%. But today I kind of wanted to just go back to basics. Let's talk about what an interest rate is, as well as maybe some factors that influence these interest rates. So in the simplest terms, the interest rate is basically the cost of borrowing money. It provides a certain compensation for the lender taking on the risk of lending you the money, the risk being that you might not pay back that money. So that level of compensation is the interest. Borrowers pay interest because they have to pay the cost of purchasing that item now, rather than saving up for years in order to purchase it later. A great example is a mortgage for a house. Let's say, for example, somebody wants to purchase a $600,000 home, but they don't have $600,000 in cash, so they go to a lender to try and get a loan for the remaining amount of money that they need to purchase that $600,000 home. Now, somebody with a lot of money, like a bank or a private lender, for example, will lend them that extra money, but they will want an additional sum of money on top of what they lend for giving you that money. They're not just going to give it to you for free in hopes that you'll pay it back. They want a sum of money that's going to help kind of mitigate the risk of loaning you that sum of money. This is your interest rate. Now, typically you'll get a lower interest rate when there's some sort of collateral for the transaction. For example, let's go back to that $600,000 home. So a lender will be more comfortable lending you money because they have the house as collateral. So they'll do it for a lower interest rate than if they didn't have that collateral. What does collateral mean? Well, if you default on your mortgage and you're unable to make your mortgage payments, in some cases, the lender will actually have the right to take possession of the home or sell the home, and that is what they use as collateral. So they're comfortable lending you the money at, let's say, 4 or 5% because they know that they have that home as collateral, worst case if you're not repaying back the loan. So what factors actually influence interest rates? Well, the first is the demand for credit. Now, credit is a fancy term that's basically the money that is lent to borrowers. Now, if a lot of people are borrowing money, that means the demand for credit is high and interest rates will likely increase. On the flip side, if a lot of people aren't borrowing money or getting credit, then interest rates will actually decrease as demand goes down. This is a simple kind of supply and demand curve. So if supply stays fixed and demand goes up, we can charge more. If demand goes down and supply is fixed, we'll charge less. And that's what you really see with the demand for credit. Another factor is inflation. Higher inflation will likely raise interest rates because lenders will want to make up for their lost purchasing power. Simply put, because the cost of goods have gone up, lenders will want an extra security when they're lending you that money. So when does inflation rise? Well, typically you see it when a larger sum of money is chasing fewer goods. So when there's more money in the system chasing fewer goods, you'll see inflation on the rise. Again, this is that supply and demand. Fixed amount of supply, higher demand, more money. You'll see the prices rise. And again, if there's fixed supply and lower demand, you'll see prices start to fall. For example, let's look at the housing boom in Ontario over the last 1.5 years. Now, the inflation was partly caused by the purchasing power being so high. It was so cheap to borrow money, and it was chasing fewer goods. There weren't a lot of listings on the market. So when the demand is so high and there's not a lot of listings on the market, you see prices start to increase. Finally, there's the Bank of Canada. So when an economy is starting to struggle or there may be feeling some shock, like they did with the COVID-19 pandemic, the Bank of Canada will actually reduce its interest rates in theory to stimulate spending. This allows businesses to pay a lower interest rate on new and existing mortgages and loans, and also encourages people to borrow money to spend it on things. This, in theory, will strengthen the economy. However, if an economy is growing too quickly and inflation is on the rise like it is in 2022, the Bank of Canada will want to raise their interest rates. This forces people and businesses to pay a higher interest rate on their loans and mortgages. It also discourages people from borrowing and reduces overall spending activity. This is the plan right now, to raise rates to get inflation under control. Now, how does this affect you as a potential home buyer, seller, or refinancer? Well, the interest rate that the Bank of Canada sets is called the overnight rate. Now, that is the overnight rate. There's another interest rate that's important to pay attention to. This is the prime rate. This is a rate offered by the big 5 banks in Canada, and this is essentially what your mortgage rate is. Now, the reason these Bank of Canada increases are so important is that when the Bank of Canada increases its overnight rate, the prime rate almost responds immediately with that same increase. So as the overnight rate just went up about 0.5%, you can expect the prime rate to go up 0.5% as well. Now, what does this mean for buyers, sellers, and refinancers? Well, for refinancers, we see about typically 20% of homeowners refinancing every single year. Generally, that's based on your 5-year fixed. And what we'll see is when you go to renew that mortgage, you're going to have to pay the current interest rate. So this could increase your monthly payment at the time of refinance. Now, you'll also see this with buyers. So buyers, now that the interest rates are so high and more of your payment is going towards your interest, you'll see their qualification numbers start to drop. So they won't be able to qualify or afford as much home as they could back when interest rates are lower. What does this do? Well, it causes the sellers to sell for a lower amount because there's not as many buyers out there with that higher pre-approval. They can't necessarily afford the home, and this creates a drop in the market value of homes. This is their whole plan. They want to cool the housing market and cool inflation, and they're doing that by increasing the interest rates or the overnight rate. Alrighty guys, that's all for me. I hope you liked this video, and I hope you learned something about interest rates and how these Bank of Canada increases might affect you as homeowners or buyers or sellers. I'm Alex Blencarn, and if you like this video, please drop me a subscribe and a like below. It really helps out the channel. Until next time, guys, this is the kitchen table. Take care.